Hello there. Welcome to the Indian Insight channel. Today's topic is on the Japanese stock market. As you might have heard, the Japanese stock market hit its all-time high this year after a period of 35 years. That is, it has taken this index, the Japanese leading index, almost 35 years to make a new all-time high. Purpose of today's video is to study these major corrections that may be a part of any market and to figure out what we can do to protect ourselves from implications of such a big correction. My name is Yash Utmani. A disclaimer first. This video is for education purposes only. For your investment needs, please consult a registered investment advisor. No part of this general commentary should be treated as an investment advice, as individual requirements may be different, and it's best for you to consult a proper registered investment advisor. With that out of the way, let's get started. This here is the chart of the Japanese stock market. This is the index, the leading index, and this index made a high of 38,957 in January 89, and after that it began a prolonged downtrend. Now, of course, when there was a big market crash around here, no one would have thought that this market correction would last 35 years. However, in case of this market, what happened was that the stock market fell and it kept falling till January of 2008 when it made its final low. And since then, this market has been steadily rising up. And finally, in 2024, this market was able to make a new high. There were many reasons that I'm sure some of you may be aware of. For example, Japan became a developed economy. It was one of the richest countries at the time of occurrence of this trend reversal. One reason that is commonly cited for stagnation of the Japanese economy was the fall in fertility rate, and there was also coincidentally a real estate bubble at the time when the index peaked. So this is not a very uncommon occurrence that real estate sector does well and there is a bubble in the real estate sector at the same time there is a bubble in the stock market. What is more important to note is the length of this stock market rally. We have data going back to about January of 1950. So from January of 1950 to January of 89, there was a broad uptrend in the Japanese market. So that lasted around 39 years, or rather 40 years. This uptrend meant great development for the Japanese economy and rise in income for its people. But after that, the stock market peaked. They had their issues, which is natural for any developing country or for any developed country or for any business, that a period of prolonged uptrend may be followed by a period of prolonged downtrend. This possibility cannot be denied when it comes to any stock or any market. Even though the fall in the Japanese index will mostly be attributed to the fall in the fertility rate, the fact is there are other markets which have faced a prolonged period of downtrend. Let's look at some other examples. Let's look at the Dow Jones Industrial Index. In case of the Dow Jones Index, you see that in January of 1929, this market peaked, then it fell by almost 90% by January of 1932. And then the market took a good 20 years to make a new all-time high. So a new all-time high was made in January of 1954, while the previous peak was in January of 1929. So for 25 years, the American stock market did not make a new high. This scenario repeated again around January of 1965. So here you see that this market stayed in mostly a horizontal consolidation for a long period of time. From January 1965 to January of 1982, that is for about 17 years, the market remained sideways. Then let's look at another index. Let's look at Nasdaq. In case of Nasdaq, after the dot-com bubble burst in the year 2000, the market didn't make a new high till January of 2016. So it took almost 16 years for the Nasdaq index to make a new high. Now let's look at another index. Here is the Hang Seng index. The Hang Seng index since January of 2007 has broadly been in a consolidation, and it has not made a new high, or at least it has not sustained a new high. It made a new high in January of 2018, which was after a period of 10 years, and then again the market came down. So effectively it has not made a sustainable new high in the last 17 to 18 years. So my message to you is that a prolonged correction can happen in any market, and for n number of reasons. So Japan is not a lone case, but Japan is one of the longest periods of correction that we have seen in the stock markets or all over the world. However, corrections that lasted for 10 years or 17 years have happened in almost all markets that you can think of. Now, in light of this, to expect that the Indian market or any particular market may not face a similar scenario for some unknown reason, let's say, is not reasonable. And so it is very important that you find ways to hedge against this risk of prolonged correction in any market. Hang Seng or the Chinese equity market are a great example where, although the indices didn't make new highs, the economy kept growing. So you should understand that just because an economy is growing, it does not mean that the stock market might necessarily keep growing. This is because if the stock market becomes severely overvalued, then the earnings and income of the country and the per capita income of the country may take time to catch up to those valuations. So if such a scenario unfolds in any index or in any market, then you should have or certain strategies to mitigate the effect of a prolonged downtrend. So now let's see what happened in case of Japan and what were other markets doing at the time when Japan was struggling. This is the Japanese stock market. Let's look at what Dow Jones was doing around the same time period. While the Japanese stock market fell from a high of 38,957 to 6,994, we see that the Dow in fact rallied from around 2,700 levels to about 18,300 levels. So it made a high of 18,300 2007, and then we saw a major correction and it fell to 10,000. But even then, if you compare this index to what happened in Japan, it yielded positive returns for any long-term investor. Let's look at what happened with Nasdaq. In January 1989, Nasdaq was trading around 200 levels, and by the time the Japanese market bottomed out, it had already made a peak of 4,800. So it had gone up by more than 20 times in the same period, and after that there was a major correction due to the dot-com bubble burst, and even after that correction, Nasdaq index ended up outperforming the Japanese market. Let's look at what was Hang Seng doing at that time. When the Japanese stock market peaked, Hang Seng was around 2800 levels, and by the time it had bottomed out, Hang Seng had already made a high of 31,958. So from around 2800 to 31,900, that's more than 10 times the market had risen in that period when the Japanese market was struggling. Of course, since January of 2007, the Hang Seng index itself started struggling and the Japanese market played a catch-up. Next, look at what happened to gold in Japanese yen terms. Gold was around 58,000 when the Japanese stock market peaked. After that, it also faced a downtrend for about 10 years, but it started recovering earlier than the Japanese stock market, and it crossed the high of January 89 sometime in January of 2005. So it took almost 15 years for gold prices to recover. However, for the stock market, that is the Japanese stock market, it took much longer. Now let's look at Silver. Silver was around 745 when the Japanese stock market peaked. However, the high of 1989 was breached only in January of 2005. So for 16 years, silver also did not break the high of January of 89. So it took lesser time than the stock market for this gold and silver to recover in terms of Japanese yen. Let's look at what happened to Sensex and Nifty during that period. So Sensex was around 778, and since then we have seen a tremendous rally in Sensex, where today we are sitting at around 80,000, which is almost 100 times the price in January 89 when the Japanese stock market peaked. So the question is, today we have also seen a tremendous rally. This rally has lasted for over 30-40 years now without us seeing a prolonged correction. But the question is, can we completely rule out the possibility of a prolonged correction in the stock market? Can we perfectly predict that a 15 or 20-year prolonged correction cannot happen in the Indian stock market? And this is for you to answer, but I believe it is highly unlikely that we will never see a prolonged correction in Indian stock market. So in our lifetimes, it is very likely that over next 20 or 30 years, you may see a period of prolonged correction that may last for a long period of time. Now, the only hedge against this is to make sure that you are invested in multiple markets. So from the examples we saw, if someone was only invested in the Japanese stock market, then they would have had a far tougher time than if they were diversified into, say, other foreign stock markets. And one thing is for sure, that today it is much easier for you to trade and invest in multiple stock markets compared to, say, 30 years or 40 years ago. So today it is much easier for you to stay in India and invest not just in the Indian market but also in the US market, some Chinese stocks, or have some exposure to foreign equity so that you are well diversified. So in light of this, it's very important that you should not limit yourself by investing in just one country. Instead, my suggestion is to diversify into multiple countries and also multiple asset classes like commodities and cryptocurrencies to insulate yourselves from the possibility of a prolonged downtrend affecting your returns and affecting your investments and affecting your future plans. With this, we come to the end of this video. I hope you liked it, and if you did, please remember to subscribe to my channel and share this video with your friends, as it would serve as a bit of encouragement for me to share more videos with you. With that, goodbye for today, and thank you for logging in.